And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday, which means it's Two Dads on Money. John Penn joining me this morning. And of course, markets continue to do very well. Everybody's chasing momentum. Everything's fine. We're going to talk a little bit about that this morning. Also, one of the things over the last couple of days in particular to be paying attention to is that, there's this whole narrative that's beginning to really kind of drive the markets is that, nothing can stop the market. And it certainly seems that way. And that's the kind of the general tendency. This market just goes up every day. Even yesterday morning, tried to sell off a little bit in the morning. And then markets rallied right back, started running, to new highs yesterday. Again, and it was interesting yesterday in particular because it was pretty much just Oracle, NVIDIA, and Apple driving the markets. And that was all kind of on the back of this TikTok news more than anything else. Of course, NVIDIA is announcing that they're going to make a $100 million investment into OpenAI. NVIDIA has kind of been doing a lot of deals lately, one with CoreWeave, one with OpenAI, also looking at XAI, which is the AI run by kind of Tesla. They're just doing a $10 billion funding raise for that company. Doing a funding raise at a $10 billion valuation. So again, just this whole movement towards AI continues to build that narrative into the markets. And it's kind of interesting because just a few months ago, AI was dead. Remember that? AI's over, all the projections are wrong, et cetera. And now that's completely kind of gone out the window. So this whole AI chase is back. The narrative is back. The momentum is back. In fact, momentum factor, if you take a look at the momentum ETF, MTUM, it's just having a stellar move higher here as people just continue to kind of push into that momentum trade. There's an ETF called AIQ. It's the Artificial Intelligence ETF. That's had the most consecutive up days in a row ever on record for the history of that particular ETF. That ETF hasn't been around for very long, but it's just been a consistent drive higher in that ETF. Just going back to this whole narrative about the AI chase, et cetera, kind of being, kind of the place to be. So again, nothing wrong with that. But again, what goes up eventually does come down. The question is always when, always the timing. Today marks the beginning of Rosh Hashanah, and there's an old saying that you basically sell Rosh Hashanah and buy Yom Kippur, which is on October the 2nd. Now, the dates move every year because it's based on the Jewish calendar, but it basically starts today. It ends on October the 2nd. That also corresponds with seasonal weakness in the markets, which always happens at the last part of September. So is there anything there? I don't know. But again, it's just kind of it's just kind of the statistics, old axioms on Wall Street. John is very familiar with the Jewish calendar. Right, John?
Very much.
There you go.
Very prepared to talk about that this morning.
You are? Okay. Yeah. Well, I mean, the way you pinch pennies, I just assumed.
Oh. See, you've been talking with my wife, haven't you?
Exactly. Well, we're going to talk about that this morning. But anyway, let's get a little bit what you need to know before the bell this morning. Markets, like I said, continue to trade up and running along moving averages. So if you take a look at really short-term kind of trading moving averages to look for short-term support, this is the 14, the 21, the 35-day moving average. So they're all very much clustered very close together. And that's because this market's just been in this consistent kind of trend higher. Pullbacks to the 35-day moving average have been consistently bought. That's where you continue to find buyers stepping in. The one thing that really kind of notes this morning, and we've talked about this before, is extensions in markets tend to get reversed at some point. The last time that we were kind of this overbought in the market was near this little short-term little blip we had. We had a couple of down days that took us back to the 35-day moving average, is about a 3% clip in the market. Nothing major, but that also corresponded with a drop-off in money flows in the markets, even as the markets were rising. So you had this negative divergence of declining money flows while the market was rising and the market was very overbought at the same time. Now, interestingly enough, we have exactly that kind of same setup right now, which is a very overbought market. Markets continuing to rise, and we have a negative divergence in money flows. So it just suggests that the buying in the market is beginning to weaken a bit. Sellers are starting to show up here. Hasn't been reflected in the price yet, but that's not uncommon. But again, we typically kind of see that negative divergence in the markets when money flows into the market, in particular, when markets are overbought. Markets are getting very overbought here. Professional investors kind of scaling back just a little bit, taking profits. Typically takes a little bit of time to work itself in, but right now, if we get a correction back to the 35-day moving average, that'd be about 65.20 on the index. So again, it's not a huge correction, but it's about 150 points basically from where we are, back to those levels. So again, it's just been a very, very big rise here. So again, you kind of get a pullback to some level of support. There's a very good potential that if you get a bigger correction, it takes you back to the 100-day moving average, which is 61.80. So there's some support immediately below where the markets are now. There's also the 50-day moving average sitting around 60.50-ish. So again, there's 6,500-ish. So there's multiple layers of support. So even if you get a pullback here, it's likely not going to be deep, kind of getting set up for that year-end rally. Again, we're about to kick off earnings season. That's something we'll talk about here this morning as well. President Trump has announced that he's kind of pushing, and the SEC is actually starting to take advice on this about reducing the reporting requirements from being quarterly to semi-annually. We can touch on that a little bit this morning as well. But again, nothing wrong with the markets here. But again, just understanding that markets are very extended, very overbought. We're starting to see a bit of correction here. And this is across multiple asset classes. This isn't just the S&P that looks like this. We're seeing this in multiple areas because this momentum chase has been kind of running across markets. NASDAQ looks very similar to this, very overbought, starting to see some weakness in money flows. Equal weight is not the same. Equal weight has not gone much of anywhere here, but you are definitely seeing the decline in money flows in the equal weight index. Breadth of the market has been very tentative at best. We saw that yesterday in particular. The only reason markets were up yesterday is because of three stocks primarily. The rest of the market was not doing much, but you are starting to see more declining money flows even in the equal weighted index. Stepping back, looking at the dollars continues to kind of just base here, long-term base here. That's not really helping or hindering things right now, but that is supportive for assets that are dollar sensitive. So, one of the things that we've talked about before is looking at light crude oil because, again, the expectation here is if we're going to have a stronger economic growth cycle, we should be seeing a pickup in oil prices, right? The more demand for energy, stronger economic growth, that's the hope. So far, we haven't seen that at all. Money flows continue to be very negative in oil prices. Oil prices really haven't gone much of anywhere at this point, which is interesting because when you take a look at energy stocks, which typically should trade as a very close proxy to oil prices, they've actually been doing much better. So you have a divergence between a sector of the market versus its commodity, which is unusual because oil prices are where the profits for these companies come from. So there's a pretty big gap there, which suggests that either oil prices have to catch up with energy stocks or energy stocks are going to have to catch down with oil prices. We'll see what happens. But economic growth is going to be kind of the key here as we start to look forward. That's what you need to know before the bell this morning. We'll come back, pick up with John Penn, and talk a little bit about what you're looking for in a financial advisor when you start to actually look for one. When do you actually need a financial advisor is a bigger question. And also we'll talk about a little bit about this quarter to semi-annual earnings reporting. Is that really a good thing or not? All coming up on this morning on Two Dads of Money. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to Two Dads on Money this morning. Of course, John Penn joined this morning. Good morning, John. How are you?
Morning. Good. How are you?
Good. Just got a few things to get into this morning. One thing I just wanted to kind of touch on earlier, I'm getting a lot of emails about this. President Trump recently announced that he is going to start kind of pushing the idea of moving earnings reporting from quarterly to semi-annual basis. And I'm getting a lot of questions like, is this a good thing? Is it not? The SEC is actually considering this. So they're doing some early kind of reviews. But, I don't know what your opinion is, but, I think personally it would be kind of a good idea. I would be all for going to annual reporting. Now, the arguments for the quarterly reporting is transparency, right? So if they're reporting on a quarterly basis, you're getting this really kind of good insight to the company, you're getting this, kind of this real-time view of what's happening with the company. But if you think about how most businesses run, they file taxes once a year. So again, they're not publicly traded. These are most of your private companies, but you file your taxes once a year. So you do your books at the end of the year, you figure out what your profit loss was, you file your taxes and you run your business. Now, companies are keeping up. They're not just waiting till the end of the year to figure out what's going on with their business, right? They're doing this on a monthly basis, but that's when when you actually look at a business, you're looking at annual reports. Say I want to buy a small business, right? I'm going to go buy a dry cleaners business on my street, down at the end of my street. Well, they're going to give me their financials, which are all annual, right? So I'm going to see their annual reporting. Now, in the financial markets, the argument is that we need more of this, right? We need it quarterly because if we have these quarterly reports, and there's a variety of reports that come out, right? So you have your 10Qs, which are your quarterly filings, and you have your 10Ks, which are your annual final kind of end of the year wrap up. Those are the ones that actually are for your tax filings. So these 10Q reports are important according to investors because it provides a lot of transparency. I get it. But there's also some drawbacks to such a frequency of this. First, the Wall Street Journal did a study about 5, 6, 7 years ago now, and they interviewed the CFOs of all these major companies. And when they asked them about their accounting practices at these major publicly traded corporations, they go, oh, well, about 10% of our numbers are fudged to meet quarterly reports. So remember that Wall Street is the ones out there making all these estimates based on their conversations, what they think about the economy, and also they're doing investment banking for these companies. So they're raising the estimates so they can do secondary stock offerings. They can help with the stock option compensation plans and the share buybacks and all this stuff that goes on. So they're always optimistic. And so that puts pressure on the companies to fudge their earnings a bit to meet these, kind of elevated Wall Street estimates and also to meet investor expectations so their stock prices go up so that they can cash in their stock options. This has become much more prevalent really since 2000. Prior to 2000 it wasn't this way, but it's become much more prevalent since 2000. I remember in the late 90s there was a law change. The SEC required that all companies release information at the same time in terms of if I'm going to have an investor relations, kind of press release, I have to release it to the media all at the same time. So there was this Transparency Act that was passed in the late 90s to give access to information to all across the board. So this gave access, to Reuters and Bloomberg and everybody else have real-time information coming out so they could trade off against that. So we've been moving this process over the last really few decades to having this real-time feed of information. But there's a few drawbacks with that. Like I said, one is this inherent push to meet quarterly numbers. So I'm required to, make a few adjustments here and there, maybe cookie jar some reserves, maybe bring forward some revenue that I haven't actually collected yet, CoreWeave, those type of things to help meet these estimates to keep my stock price up. If moving to a semi-annual basis, it releases some of that. Even if I moved to annual, it would take a lot of that pressure off companies so that they could actually just run their business, grow their business. But hey, I get it, right? We all want information. But the other side is the cost to companies. To file quarterly reports, it's a major cost, right? You think about all the data that's got to be accumulated. You got to get the accounting staff done. You got to get them audited. You got to get all this stuff every quarter. And that's not a cheap process, right? So it takes a lot of time, takes a lot of manpower. We haven't got to AI yet, but that'll eventually get there and speed things up. But there's a lot of cost to that to companies, and so you would help save some of that cost and time and money that is impacting and that disruption for the company of running their business by moving to a semi-annual basis.
Yeah, I mean, you see, some of the reasons why companies decide to go private instead of trading publicly is that fact right there. It's just the cost and the cost and the time that it takes to report and on a quarterly basis. Because I can't believe it's late September already. I mean, 12 weeks. When you look at this from a quarterly reporting standpoint, it goes by like that, right? And so yeah, I can see your point where, hey, it's the 11th hour. We're about to announce earnings. So we got to make sure that this looks good tomorrow. Otherwise, investors are going to sell our shares. Right? There's tremendous pressure going on there. So I like the idea of semi-annual reporting. Actually, if you could do this once a year, that might even be better in my opinion. But I don't know how the market would react to that, because as investors, we are so used now to data, constant data, 24 hours a day, 7 days a week, 365 days a year. I'm just really curious to see if this really gets pushed through, how investors in the market would really react to this.
Well, probably what will happen, and this would be my guess, is that let's just assume for a second that it did get passed, right?
Yeah.
So now companies will have to report every 6 months, right? So, and that's based on their calendar year. So their calendar year could start in September, it could start in January. So their 6 month clock starts whenever their calendar year starts. But what companies will do is because they need to make sure that they're keeping their stock prices up for their stock option-based compensation, et cetera, they'll still do quarterly, either quarterly or however often they want, but they're going to make announcements. They're going to talk to Wall Street. They're going to have, press releases, these type of things to help keep that information flow out there. So there'll be a push, as is always the case with Wall Street, right? So when there's ever a law change around something that potentially impacts the revenue for Wall Street, they're going to figure out a way around it. So what they'll do is they'll organize investor conferences, whatever it is, that they will go and talk to these companies, get reports, even though they're not official filings, right? It'll be you have the 10Q, I guess you call it the 10S. It's the semi-annual filing, but but instead of that semi-annual filing, they'll come up with other metrics or measures to get a real-time pulse on the business, because that's what's driving these stock buybacks. It's what's driving a lot of the markets, is that real-time pulse of information that comes out. And again, the markets. And look, I'm not denying that the markets need that, because they've got to have that feed of information.
Yeah, right? I would wonder if companies started reporting more semi-annually. I guess officially, would this maybe calm markets down a little bit or create less volatility around times when there are earnings announcements? Or if companies just decide, well, this isn't going to be a formal earnings announcement, we're going to make an announcement anyway, would that kind of fill the void? In other words, I'm just curious if this would have any effect on market volatility whatsoever.
Well, it would probably calm things down a little bit from the standpoint that, again, just think about this. We just finished earnings season like 3 weeks ago. Right, we had NVIDIA report. They're pretty much telling. I mean, we just finished up Oracle just a couple of days ago. Oracle just announced, right? And in 2 weeks, we're going to start this all over again, right? So as soon as you finish one quarter's reporting, you've already got the next quarter reporting started again. So everybody that just finished up reporting is now going to have to start getting ready for the next quarter's report. And that's what I'm talking about. Is like, it's almost just a nonstop process of getting, these report filings together, getting the projections done, all this type of thing, which again, huge cost of time, money, power, employee power, et cetera. And again, kind of smoothing that out some will help. But again, if the other side of this is that potentially it would, kind of maybe pull some of the froth out of the markets, speak by just slowing. And again, this has always been, the issue we talked about the other day with talking about Citadel Securities, and you think you're getting free trades on Robinhood, but you're really not, because you're getting kind of lump summed and front ran by other people. They're making money off of you. There's nothing free. And this is kind of the same thing with the market, is that this dependency on information flow helps keep these, it's constantly, I think this is better than it is, I think this. And if you kind of slow that information flow down a little bit, and this is the benefit of paying a commission, right? It slows you down on your trading a bit and actually makes things a little bit better in the markets.
Yeah.
There's some potential benefits from that as well.
Yeah, I see that. I remember when I first got started into the business in the late 90s. We thought we had a lot of information at our fingertips then, but I was also the one tasked with the firm at the time to replace all the value line, all the information that would come in off value line.
Right.
I would have to update that in all the binders. And now you ask kind of a new advisor in the industry today around, hey, what do you think about value line? They're like, what's that?
Yeah.
Or what is that? But we thought at the time, then the internet was coming out in late 19, that we had a lot of information at our fingertips then, but compared to what the information flow looks like today, there's no comparison, right? So I see what you mean with having all of these, maybe slowing things down a little bit, which maybe can kind of soothe this volatility in the market somewhat. It'll be interesting to see just how the market reacts to this, because I think with earnings announcements too, I think sometimes investors are very curious around, yes, how did the company do last quarter? What were their numbers? What were their earnings? But I think even more so, investors are paying even more attention to, or as much attention to, what's the forward-looking guidance look like? Yep. So maybe if companies start reporting earnings, let's say, every 6 months, maybe in between those reporting periods, they're giving updates on forward-looking guidance. I'm not sure.
Yep. Something else we need to probably stop is Fed announcements.
Yeah.
Having all these Fed speakers run around, nobody cares what they actually have to say, right? But it's all about what they're saying about Fed policy. But that's also another group of people we just need to pull out of the financial marketplace as well. We just don't need to hear from the Fed. The Fed should be behind the scenes, which is where they were supposed to be. And they were all the way through really the late 90s. Greenspan was really the one that started the kind of public press conferences and wanting to be more transparent about what was going on with the Fed, and now it's just gone into overdrive. Now you have just Powell speaks today is a good factor of this. So everybody's glued to the monitor to see what Powell's going to say. He's not going to say anything different than what he just said at the last meeting just 2 weeks ago. But it's just the whole market is now, and this is my whole point, is that the market is no longer focusing, and to John's point, no longer focusing on the fundamentals that drive markets, right? Earnings growth, fundamental valuations, price to sales, those type of things. That's the way the market's used to trade. Now it's simply just one headline to the next of potentially what's this going to mean? Is the Fed going to cut rates more? Yes, no. If they maybe no, the market sells off a lot. But this is also the problem with high frequency trading and computerized trading systems and algorithmic trading, is that we're all just tied to news flow now.
Yeah, it's one narrative after the other. What happened last week? It's out of sight, out of mind. And what's the narrative this week? And it's just a constant flow of data. It'll be interesting to see how the market reacts to this.
No, it is. But again, I was talking about this morning that it's all about momentum right now, and it's kind of crazy. This is a chart I posted this morning on X, which and I labeled it, "You've got that love and feeling," because this is the momentum factor divided by the SPX, which are the SPY. It's now at the highest level it's been since the market peak in 2020. All right, and of course in 2022 was where, again, this is the thing about momentum. It takes a while to roll off. I'm doing kind of a research study right now. I'm looking at relative strength when on a weekly basis, relative strength is above 80. How long is it until the next bear market, right? And on average, it's about 33 weeks. Right, so I'm doing that work. I'll have an article out probably on Monday about it, but I've just been kind of going back to 1970, looking at all these relative strength reading over 80, which is where we are right now. We're at 86 right now on a weekly basis. So again, kind of the clock's already started to tick in potentially for the next correction, but it doesn't happen tomorrow, right? It takes 12, 24, 36 weeks before you get there. And by the way, 52 weeks is a year, just keeping things. Keeping the math, right?
Appreciate the math.
There you go.
But that speaks to a lot of questions that I get as of late too, where there are a number of folks that have been kind of resting in T-bills or money market funds, and now they're starting to see their interest rates go down. So now I think they're feeling forced that they need to start deploying their money into other asset classes, maybe including equities, maybe even dividend-paying stocks, just to try to recreate some yield. And kind of a common concern that I receive is, man, John, look at these markets. They sure are pricey, aren't they? They're frothy, right? And there's a lot to be said where I could agree with that, but at the same time, you have to look at money flows and look at momentum, right? Because all of these money flows that are coming into the market through passive ETFs, index funds, et cetera, that can help support share prices. But to your point, this momentum could stay strong for a while. It might be a year, 18 months, 2 years, 3 years, 4 years before we see something change, right? And so I think there's a lot of folks out there that are kind of torn with, how should they interpret what's going on in the market? And I think they want to start investing, but they just feel that markets are overpriced. So I think that analysis that you're doing on momentum and looking at what's the peak before the next bear market, that's all very helpful. I think that speaks to a lot of those folks who are in that very situation right now.
Well, again, it's just, it's always important to understand, markets move, but, and this is always one of the big kind of emails I'll get a lot is because I'll talk about, hey, this is where the markets are. We're very overbought. It's going to potentially get a correction, but hey, the market could keep going higher. Yeah. There's not a definite, people say, well, just pick a side, right? Either you're bearish or bullish. No, you can't, that's a trap, right? Picking one side or the other is the trap. The goal is to stay neutral and just understand that markets can remain overbought for a lot longer than you think, and then they will eventually correct. Nothing goes up forever. So we get trapped in these bullish or bearish narratives. Yeah. And it's like, oh, the market only goes up from here. No, it doesn't. And when markets start to correct, oh, they're only going to go down from here. No, they're not. So it's important to understand those dynamics and just remain neutral and just understand that these are the risks and weigh those probabilities of events as they occur. Yeah. So, but that's also kind of brings us to our topic for today, which is kind of choosing the right financial advisor. There was an article out on CNBC talking about red flags to watch for when getting a financial advisor. I think the first question is do you actually need a financial advisor? And if you're young, just starting out, probably not. There's so many tools online that are free that can help you do some basic budgeting, kind of get your household in order, help you pay off debt, those type of things. Those are kind of the key factors when you're young. Just to be focused on get yourself out of debt. Big lies in the market. You need a credit card. No, you don't, right? Oh, I got to have a credit card to have a credit score. No, you don't. So don't fall into that trap. Don't get yourself stuck in that whole debt trap, right, that the banks want you to get in, because once they get you in that trap, they just keep collecting money off you. That's why banks are rich and you're not. Stay out of debt is kind of cool. So you don't really need a financial advisor at that point. When you start to really need a financial advisor is when you've got some assets that actually are there, you need to have them managed, and you need to start building a plan to get those assets to grow for your retirement and start working on your savings. I've got myself out of debt. I've got myself pretty well structured. Now I need a plan to start, getting how much do I need to be saving for retirement? How much do I need in terms of return from the market to get where I want to go financially? And building that pathway and having a professional to work with that is saying, oh, look, hey, you want to go buy a house? Let's go see if we can make this make sense right now. You want to go buy a car? Let's see if we can make this sense right now. It's like, do you want to buy new or used, right? What's better? Do I lease or do I buy? Well, there's benefits and drawbacks to both. So there's a lot of things that the financial advisor can help you with, make better financial decisions. But you kind of need to be in the disciplined and mental space to really take advantage of a financial advisor and make it work. Just having a financial advisor for the sake of having one doesn't really mean a lot.
Yeah, I mean, in my opinion, I think the role of a financial advisor is one of an educator, right? To teach, to educate, and to show the individuals and families that they work with, what are their options? Hey, if you do this, here's how things might look. If we do this, here's how things might look. Which option can set you up for potentially the best success looking forward? And all of the planning that Lance was talking about. I mean, what we're trying to do when we're putting financial plans together, financial forecasts together, we're trying to predict the future, right? Which is the unknown. But let's at least get a sense of kind of where you are, where you want to go, and let's put what I think are some reasonable, forward-looking expectations together to see how this can start looking down the road, 5 years down the road for you, 10, 15, 20, 25, 30 years from now, right? What are some things that you can be doing now to really set yourself up for even more success in the future, right? So that's how we tie this all together. So, but when you're kind of getting started, you keep it very simple. But then I find that as your money grows, it's not uncommon where you start having accounts kind of scattered all over the place, like Beanie Babies, if any of you remember what those are, right? And how can we help you kind of streamline this and consolidate and just kind of make this simple again, right? So it's just about, again, I think it's really about being an educator and showing you what your choices are. And you're smart. You're going to make the right choice that makes sense for you, but let the advisor work with you and coach you through that process.
Right. And that's also, one thing too is that when you're going to go out and hire a financial advisor, and again, we're going to talk about credentials here in a second, because credentials are good, but they're not everything, right? We'll talk about that in just a second. But everybody's like, they want to find a financial advisor that agrees with them, right? No. Don't find it. Just because the advisor agrees with you on every single topic doesn't mean that's a good relationship. You want a financial advisor that's willing to push back on you and say, no, you should not be funding your kids' college, because if you do that, you're going to basically run yourself into being broke in retirement. Right now, your kids are going to have to support you in retirement. You don't want that. So you need an advisor that's willing to stand up to you and say no, right? Kind of like, well, it doesn't really work with your wife, but we'll talk about marriage tips in a minute.
Do as we say, not as we do.
Yeah, exactly. But you do need a financial advisor that's willing to I don't want to say be a parental figure in a way, but be somebody there that can say no to you and can say, this is not a good idea and this is why. If they're just saying yes to everything you want, that's not really helping you get to where you want to go.
Yeah, I like to say, so I am here, like an advisor should be able to say, hey, I'm going to remind you to eat your vegetables, right? Let's eat some of that broccoli that's on your plate. It may not I personally, I like broccoli, but maybe you don't care for it, but it's good for you, right? Peas?
Peas.
You don't like peas?
No, terrible.
Peas are glorious.
I hate peas. Broccoli, good. Peas, no.
Oh, no, give me some peas. Sorry. So, but
all you do is chase them around on a plate with a fork.
You just get a big spoon. I just put them in a bowl and go after them. Love me some peas. So, but we should. Part of my role is to remind you to eat your peas or eat your broccoli or just eat your vegetables or maybe do some things that. Hey, this is what you want to do, but maybe we should do this instead, right? Mm-hmm. So great point.
Yeah. Well, let's talk about credentials here real quick. So a lot of times you'll see, some guy that says, here I am, I'm a financial advisor, and he's got a whole string of letters out behind his name. Taking tests are easy, right? And they require work, and I can take a test, I can pass the test, I can get a credential. And it's good to have them, right? So all of our advisors at our company are all certified financial planners and more. Most of them have lots of degrees and certificates behind them. And that's a good thing, but it's not the be-all, end-all. Just because somebody's got a long string of credentials means they're a good test taker. It doesn't necessarily mean they're a good financial advisor. So it's important to when you're interviewing your financial advisor, it's a two-way street. The advisor should be interviewing you. Are you a good fit as a client? Are you a good fit for us, right? So when we when we have meetings with clients or prospects, we're interviewing you as much as you're interviewing us. And they'll say, look, we're just not a good fit for you. You have your expectations are out of whack, or what you're requesting from us is not what we can provide. So it's an interview process both ways. So when you're interviewing the advisor, it's also important to make sure that they have a good, thorough knowledge of, kind of market history and what goes on and how things work over time, and the potential issues that could come up. But also, are they personally kind of, I've met a lot of advisors that are financially broke. So, it's important to understand that they're also walking the same walk that they're teaching you, and that they're being an advisor. That's great. But are they experienced? And so experience is just as important as the credential itself.
Yeah, I think so too. It's when you're out there visiting or interviewing potential advisors to work with, I think it's very important to ask the question are they a fiduciary, right? Yeah. Which means they have to put your interests ahead of their own at all times. They're bound to it, right? And there's different ways to be a fiduciary. The firm that they work with is the firm registered with the Securities Exchange Commission. Based upon how the firm is registered, the firm is a fiduciary. Therefore, maybe the advisors that work there at the firm are a fiduciary. Or, hey, is the advisor a certified financial planner? Meaning, just from an individual level, they are also a fiduciary, right? Which means they have to put your interest ahead of their own. Outside of if they're not a fiduciary, then kind of the standard of care kind of falls down to that suitability standard, right? Where, well, then the advisor isn't beholden to being a fiduciary for you. They just have to make sure that whatever investment approach or whatever type of investment, I hate to say the word product, they're recommending to you is suitable for your needs. And is that necessarily the best approach? It might be. But in my personal opinion, I think if you're looking to partner with somebody, that fiduciary should not be taken lightly.
Yeah. Well, again, you have to also be careful with that, right? Because they can, in their world, right? If I work solely for an insurance company, right? I can be a CFP. I work solely for an insurance company. I have one product to sell.
Yeah.
So I am acting in my fiduciary capacity to sell you an insurance product because that's the product I have to sell.
Right.
So you've got to make sure that the term fiduciary has some hooks to it because of the employment structure of where they work and what they have to offer. So it's important. And John's right. Being a fiduciary means I'm doing the best thing for you, but I can only do the best thing for you of what I have available to provide.
That's a great point.
So make sure that the person or the firm that you're working with, for instance, we have access to everything. So when our advisors are working with prospects, as an example, they have access to everything, and the product has to match what the actual needs are. So again, this kind of goes to insurance products, which often get sold as a kind of a be-all, end-all. Oh, just buy this annuity because if the market goes up, you make money. If the market goes down, you don't. There's a lot of caveats to that don't get exposed often, and not to mention the cost. But again, it sounds great, and it sounds like, oh, I've met my fiduciary standard. I've given you a product that's good. But a product should not be sold. It should be planned for what its need is within the overall structure. Annuities are good. Insurance products are great. Mutual funds are fantastic. ETFs are fine. Stocks are great. It does all the assets that are out there, all the different ways to invest are just tools in a toolbox. The trick is for the carpenter, in this case your financial advisor, to make sure that they're using those tools to build the structure that you need appropriately, right?
Yeah, you want to make sure there's more than one tool in the shed that they can use, right? It's a great point. Great point, Lance.
Yeah. When you only have a hammer, everything's a nail.
Everything's
right?
a nail. That's
so,
it.
The other thing to kind of watch for is just being transparent. Now, it's often this is also kind of another issue that gets a little bit kind of mangled in the process. So transparency is about fees, right? So what are you going to charge me for your services? What are you going to charge me for this? Well, there's flexibility to that, right? A lot of fees are negotiable at the time you're sitting down. So, if the advisor says, so if you go onto a website or you look at an ADV, which is the filing that RIAs have to make with the SEC, they list their maximum fee structure in that. Now they can charge anywhere below that, but they can't charge above that fee. So if the advisor says, our maximum fee is 1.5% annually based on the assets that we're managing, that's their max fee. They can't charge you more than that, but they could charge you less. So part of transparency is, okay, what are you going to charge me? Well, our fee is 1.5%, but based on the amount of assets you have, we have break points to where you can get a lower fee if if you've got a lot of assets that you want us to manage all at one time, or you've got a lot of structured issues going on. There's a lot of room for negotiation to get the right fee available for you. But when it comes to a product, there should be, hey, here's an insurance product that I think you should consider, right? Ask what those fees are, and those should be readily available for you to see, right?
Agree. Yeah, and a lot of the disclosure you can find, a lot of the information around fee structures and how a firm is organized, you can find in the firm's ADV. They have to file that with the Securities Exchange Commission every year, right? So if you're visiting with a potential advisor, They should already be forthcoming with their ADV. They should just send you their ADV automatically. But if for some reason you don't get a copy of that, make sure you ask for it, because that's where a lot of the fee schedules, will be broken down in there for you, right? And something to ask when you're visiting with an advisor, if sometimes advisory firms may charge a certain fee for investment management, but then they have additional fees for financial planning, retirement planning, converting to Roth, estate planning, whatever that might be. So it's good to ask the advisor that you're working with, hey, if you're managing assets for me, does that also cover your planning services, or is that extra? There's not a right or wrong way to do this, but you need to figure out how do firms charge for maybe some of their ancillary services. With us, when we're helping somebody in a comprehensive wealth management relationship, where in addition to Lance and the team managing assets, and then we're looking at planning, we don't charge extra for planning. That's just part of what we do. There are many individuals and families that I visit with throughout the year, and I visit with their estate planning attorneys. I visit with their CPAs just to make sure we're all on the same page together. And sometimes a client will ask me, hey, John, that's great that you're willing to visit with my estate planning attorney. What are you going to charge for that? My answer is nothing. It's part of the relationship. It's part of what we do. But it's just these little kind of one-off things that may come up where it's good to just have an idea of how will that advisory firm handle that if that's a need that you might need.
Right. Yeah, no, look, and there's a lot of things that you have to just because, and they brought up a great point in the chat, which is that Bernie Madoff was a fiduciary. So the way Bernie Madoff structured himself is that he had a broker-dealer, and then he set up an RIA, which required him to be a fiduciary, and then he was basically executing fake trades between his brokerage firm and the RIA and fudging statements. So he had his own accountant fudging the statements for all of the clients. So, obviously huge fraud that was going on there. So just because somebody says they're a fiduciary doesn't mean there's not risk. So you need to make sure and do your due diligence on the advisor, right, as well. The great example of this is just being, having some common sense about this. So I have a very good friend of mine, Tom Adjemi, who is a securities and exchange lawyer, and I've known him for, ever since the turn of the century. That's how long we go back, just to let you know how old I am. But Tom was a fantastic securities and exchange lawyer. And when the financial crisis happened and Bernie Madoff became an issue, he got contacted by people that had invested with Bernie Madoff wanting representation to try to get their money back. Well, a good example, this farmer had called him from Illinois, and it says, hey, I lost $5 million with Bernie Madoff, and I need to try to get it back. And he goes, okay, great. I need your documents. I need, your account opening statements, and I need your latest financial statements from the firm. I need the deposit amount that I need the proof of the transaction that you actually invested the $5 million. I just need the documents to help build this case, right? And this farmer in Idaho said, I don't have any of that. And he goes, what do you mean you don't have any of that? He says, well, how did you get money to Bernie Madoff? He says, I wrote a check to Bernie Madoff and I mailed it to him, right? Don't do that, right? This is one of the big red flags that was going on with Bernie Madoff, is that people were writing and sending money to him directly. It should go to a major custodian. The vast majority of registered investment advisors, and I'm going to put that number well over 99%, they have a custodian that they work with. For instance, for us, it's Pershing and Fidelity. There's other advisors that work with Schwab and a variety of others, but there's a major custodian that's holding your assets. So make sure that when you're meeting with your advisor, if they say, and there's been a lot of these scams that have gone on over the years. It's not just Bernie Madoff. I've seen tons of these over my time horizon, where it'll be some guy will throw up a shingle and say, oh, I'm a registered investment advisor, and I've got this really great trading program around foreign currency. Just send me some money and I'll invest it for you, and you'll have these fantastic returns of 100% every month or whatever. And these go on all the time. Don't ever send an advisor money directly. You cannot write a check to RIA advisors. We cannot accept your deposit because we are not a custodian. So you have to send your money to your custodian, which is a registered custodian. They have insurance, they have SIPC coverage, they have all these type of things to help protect you as an investor. So make sure that you are sending money to a custodian, not to your advisor or to your advisor's firm. unless they can prove to you that they are indeed a registered broker-dealer, they have the financial structure in place, they have SIPC covers, they have all those things to help protect your account against potential fraud or liability.
Yeah, so it's, as we are visiting with clients throughout the year and reviewing portfolios and looking at here's what we own and looking at their their investment performance. There's reports that we provide to show this data, but it's but that is separate from the custodian that we work with. So the client accounts are with the custodians that we work with, Pershing or Fidelity Investments. So when I'm producing a report to say, hey, here's the dollar amount that our firm is assisting you with, hey, don't take my word for it. Let's log into your accounts. You can log into your account at Fidelity, and there are your dollars right there. So we like having that separation where we do not want to be a custodian, right? For all the obvious reasons that Lance just mentioned. And typically, a lot of advisory firms practice that same way, where they are the advisor, they're fiduciary, helping with the asset management and the financial planning, but the actual client dollars are held with a separate financial custodian for all those reasons that Lance just mentioned.
Yeah. So again, part of just let's just kind of wrap this up. Should you have a financial advisor? Maybe yes, maybe no. Depends on you. I know plenty of people that manage their money just fine. They know how to budget, they know how to invest, they know how to plan, they do fine, right? They have these massive spreadsheets they build out, they've got all their cash flow in place. But even with them, they overlook spots that can be financially detrimental. Medicare, Social Security, Medicaid, a lot of these long-term care planning, all those type of things. There's a lot of things that get overlooked, and managing your money for retirement and getting to make sure that you're in a good, strong financial position is not just simply investing in the financial markets. And you may be very good at that, but you may be having a whole lot of other holes in your financial plan that you have overlooked or maybe just be making a mistake with. So, there is a point to where you build enough wealth, and this is why every very successful, wealthy person, they have not just a financial advisor, they have a whole group of financial advisors that are helping manage their money because of taxes, because of all these other issues that come up that they have to navigate. They want to make sure they have a very strong staff of professionals behind them, and that's what you want too. But again, early in life, if you're in your 20s, 30s, right now it's all about getting on a budget, getting out of debt, and getting invested, right? Just getting some money put to work and starting those disciplines to become a financially stronger individual. And then once you start to get, you're out of debt now, you've got yourself structured, you're saving money on a regular basis, then yes, go examine a financial advisor and hire one that will work for you. It will be well worth the fee. A lot of people say, I don't want to hire a financial advisor, I don't want to pay the fees. They will save you way more than their fees over time if they're giving you good advice.
Yeah. And just one more point I'd like to add to that. There are many folks that I work with where they're extremely astute with markets. They're very good. They're very good with their investment strategy and their spreadsheets. And I'm a second set of eyes, and I look over, are there any holes in their plans? And sometimes there aren't any holes. Folks have done an incredible job with their savings, their investment strategy, with their own planning. But it's not uncommon, especially in a couple, with a married couple, where one spouse gets a little bit more into the weeds than the other. There's one spouse that's taking care of the spreadsheet and the day-to-day, updating the numbers and looking at this all big picture. And it's usually that person that reaches out to say, hey, John, you know what? My significant other look at this together, but heaven forbid if something were to happen to me, my surviving spouse is going to need somebody like you. So maybe we start a relationship now so that way if something should happen, they know that they're working with a firm that they can trust to take care of their loved ones. So that's another reason too that folks will reach out and start to begin a relationship with a financial advisor.
Yeah. In our chat, somebody just asked a question about Pershing, because I mentioned Pershing, they're one of our custodians. Are they fairly new? Haven't heard of them before. Most people have not heard of Pershing. Pershing has been around 85 years. They were started in 1939. They're a division of Bank of New York. They're a very white glove, high net worth, basically kind of fiduciary for advisors. They provide a lot of private banking services. So for high net worth individuals, we use Pershing to get access to things like IPOs and to private banking services and institutional wealth management, those type of those kind of structures that you can't get through a Fidelity. Fidelity is very retail oriented. They're fine. We have a fantastic relationship with Fidelity. We love them. But once you reach a certain financial strata, you start needing much more of a white glove type service, which is what BNY provides. So
yeah, you find that folks that maybe if you have a lot of real estate, or maybe you need some different solutions around lending, or just to free up some, gain access to some additional options when it comes to liquidity. A firm like Pershing can there's more to offer there. So just wanted to add that as well.
Yeah, absolutely. So we said we'd end up today's show on some marriage tips, and the one thing about being married is that you learn a few things in time, and so the other day, we've talked about this before. I told my wife was saying, so now I've got a double whammy in my household. Right, so I cannot win an argument anymore in my household, and I'll explain to you why in a second. But the other day, my wife asked me to do something, and there's 4 ways to tell your wife no. I figured this out over time. One is yes. The other is yes, dear, absolutely. The other is well, I have already thought about that. Can I do that for you now? And of course, the 4th best way to say no is simply say whatever you want, right? So those are the 4 best ways in a marriage to say no. And it's always interesting when I say stuff like this. It'll always be like somebody that pushes back and says, "Oh, I tell my wife no all the time." Those people are not generally happily married. Let me just tell you, those are the ones that are generally fighting with their spouse all the time.
Yeah, if I tell my wife no, she's going to prove me wrong.
Exactly.
It's like if I say no, it's like, well, I'm going to go show you that we're going to do this anyway.
Exactly.
Right? So, or maybe it's, well, if you think it's a good idea,
yeah,
okay, then we'll go with it, right?
Exactly. So, but I told you though, so my wife was diagnosed, as you all probably know now, my wife was diagnosed with cancer. So now I've got in my household so she ordered these 2 chairs that she wanted. I'm like, honey, why'd you order these 2 chairs? I have cancer. So this is now her new excuse for doing whatever she wants. And how do you argue with that, right?
You're toast.
I'm absolutely toast.
You're toast, man. Yeah, you're like with guac. You're avocado toast. You are well done.
Exactly. Yeah. So it's just, and she's got a good sense of humor about the whole thing, but now she's absolutely using it to her advantage. So anyway. All right, that wraps up the show for the day. We will be back tomorrow with Danny Ratliff. We'll be getting into what happens today in the markets, of course, and more. If you have any questions for Two Dads on Money, any topics that you want us to cover, feel free to send us an email. Just email me at our website, lance@riadvisors.com, or simply just go to our website, realinvestmentadvice.com, and just type it in to the question box. And we're always happy to cover new topics, but particularly for Two Dads on Money, we're trying to find topics that we think will help either you with your kids or even help your kids. So again, any topics that you give us, things that you're running into, will certainly help us tailor some of the topics, to be more helpful just for you. Because again, if you're probably having the issue, probably other people are too. And John and I have both been through this with all of our kids as well. So we've already been through the hurdles, and so now we can help you relay some of the stuff that we went through with our kids to help you manage yours better. But that wraps up the show for the day. So we will be back tomorrow. Be sure to get by the website, realinvestmentadvice.com, and have a great day.